Alright everyone, Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced, negotiated in the past, we break them down, we analyze them, we find lessons and mistakes that we have made so that we can learn something from them. And most of the deals that we discuss in this series are our own proprietary deal flow. Others will be deals that we negotiated on behalf of our clients. The ultimate goal of these videos is to help all the business leaders, entrepreneurs, and investors looking to acquire assets in the United Arab Emirates and in the Middle East. So you can potentially save time, money, and resources by learning from the mistakes that we have made directly. In today's case, we're going to be talking about, probably my favorite topic, which is creative accounting, right? As I'm sure you already know, creative accounting is a very common practice in small businesses. Many people use it around the world. What I've seen, in my past experience is that people use it quite often when they need to pay less taxes. But there are still episodes of creative accounting that are happening in countries that are not taxed. For example, the United Arab Emirates. And this case talks about this particular thing. And I'm going to break down the acquisition as we always do, so you can have a little bit of an overview of what we were talking about here. So in this particular deal, we were talking about a very small business. It was a service-based business. So a lot of professionals were working in that company. And the business had been around for give or take 7-8 years. So it was a fairly established business here in the UAE. And the professionals working in it were 8, with a couple of other people acting as support to these professionals. Fundamentally, the business was a pure and vanilla transaction. There was no real estate involved in the deal. And the reason why the main guy wanted to exit this business was because he wanted to relocate back to his home country. He had another practice in his home country, so he was, breaking and kind of like dividing his time between UAE and his home country. And so he decided he wanted to allocate all this time towards the practice he had in the home country. And that's one of the reasons why he decided to sell the business. Now, most of the other providers in the business were on profit share, but he was the one taking, the biggest stake out of the business, because all the other people were leveraging his own name, his own brand to get clients. As a consequence, he was benefiting from, every person's service. With all that being said, let's talk about the revenue real quick. The business was not huge. We were looking at about $1.1 million a year in revenue, so a very small practice. And the profitability was around $250,000. So not huge, not terrible, something to consider, right? If that was the intention for us. And of course, we decided to sit down with him and kind of understand a bit more about the transaction. Now, why am I using this case as an example? As I mentioned, we're going to be talking about creative accounting. But before we actually get to that point, let me tell you how the conversation went and how we progressed in the deal. So as we started reviewing the information on the opportunity, we saw that the deal could be something that was worth, acquiring, right? Provided the guy stayed for some time, he helped us with the transition and progressively transition all his clients to the other professionals so that we avoid losing business because he was not there anymore. So it was a process that he was open to accept, and that was already a pretty good news. So we started looking a bit deeper into the financials. After some time, we came to the conclusion that this business was very difficult to finance simply because it was too small. In the UAE, it's kind of complex to finance transactions of this size. So we decided to offer him the opportunity to progressively exit either through seller financing or an earnout. And the person appeared to be quite open to that because he said, well, I'm going to help you with the transition anyway. I'm going to be in between the two countries in any case, until everything is done. So I'm okay in having this transition where I'm collecting my checks and potentially have a little bit of an upside on the price, provided I can, stay with you and deliver the service and help you with the transition. So all considered, everything appeared to go, very well. Everything was going into the right direction, and it was time for us to dig a little bit deeper into the financial aspect, the legal aspect of the business. And here's where the skeletons started to come out. Now, what we realized as we were continuing the process of analysis was that the guy has started developing in, let's say, building another office, which was very close to the previous one, and it was supposed to help them expand the business. The renovations were almost complete, and he was planning to open that up soon and bring in new professionals that could, grow the practice and so on and so forth. Now, that was not a problem because we were not really interested in taking over a new location, really, that had no business. But what we kind of realized is that might be a bit of a red flag because there was no mention to it in any document. There was no, kind of financial statement showing that huge investments were put into a new location, into building up a new location. So initially we thought, okay, the guy might have decided to invest his own capital into the deal, but it sounded very unlikely because I haven't seen anybody put his own money into a new project, at least here in the UAE. What they generally do is they allocate the capital of the business, right? Because they consider it as an expansion of the business, and rightfully so. So fundamentally, once he started talking about this new branch of his, we kind of got a little bit skeptical. We started thinking, well, there might be something hiding below the surface. And so we started asking more specific questions around the cost involved in building up that place, and where, what were the documents showing that these investments have been made. And interestingly enough, what came out was that all the information we had collected beforehand was just the financial performance of the business, taking out all the allocation, the capital allocation that was going into that new facility, into building up that new facility. And the guy didn't account for it. Their accounting team didn't put it into the books. And so we didn't have any recollection of that investment going out of the business. Now, the moment we started reconciling these two elements, we realized that this business was actually operating at a huge loss. And the guy was actually putting in his own money to keep the business afloat and at the same time build this new facility. Now, as we asked him about it, what he said to us was that he was confident the business was going to grow, and he was making sacrifices in order to explode revenue in the next couple of years. That, of course, was an excuse that we didn't accept, and it was, he had no foundation really, because it made no sense, and it appeared like something that was overexposure, right? In addition to that, as we continued our digging, we realized that a lot of the clientele that was coming to the practice was not necessarily paying in getting an invoice. So many times for these types of services, people were paying cash. There was no way for us to check how these payments were coming in and how they were reported. If they paid through credit card or whatever, we could have used the bank statements to reconcile those figures. But as most of these people came in and paid cash, these guys had to report these figures daily so that the accounting team could reconcile the books. And these guys never did that because They also never issued invoice for these services that were paid cash. As a consequence, we realized there was no way we could really understand what the business was all about, whether or not they were making 1 million a year or more. Was it profitable, unprofitable? And I think it all started with this creative accounting procedure that they used to hide, so to speak, the huge investment that was going into the new office location. Now, I've seen cases that were much worse than this in terms of creative accounting. I've seen big scandals coming out. This was not the worst thing I've seen, but still, it was a lesson for me and a kind of like a huge teaching point, because many times we might feel that people use creative accounting to dodge taxes. But even in countries like the UAE, where taxes are not a thing, or they used to be not a thing, people will still use weird procedures to create a false picture of what the company is all about. And I think it's appropriate to give you an example here, because it will crystallize this concept. This is not really a creative accounting example, but it kind of shows you how people try to change the perception of buyers when it comes to buying businesses. So one of the issues that the UAE and other countries of the Middle East are facing when it comes to business acquisitions is that there was no tax reporting obligation for the business, right? Because there was no tax, at least until 2023. So businesses had no obligation to report their yearly performance to the government. And that created an environment that was, of course, very free and quite open for businesses, but it was also quite challenging when you're trying to buy companies, because you have no ways and no document that can clearly attest whether or not that company is performing as the owner says. Now, how people solve this problem partially? Well, it became an issue of producing some sort of accounting report or audit statement, so to speak, right? So you might see that a lot more businesses in the Middle East have audit statements compared to United States or Europe, simply because they use it as the document for reporting their performance, since they don't have tax returns, for example, or a document like that can be used for that purpose. So you might say, great, a lot of businesses have audit. That's fantastic, right? That document is going to tell me clearly what the business is all about. Well, hold on a second, because not everything is as it looks. The situations I've been through, it showed me that in many cases, small business owners have audits made by local accounting firms that might not necessarily be the best ones and might not necessarily be ethical in the way they approach business. And what they will substantially do is they will take their internal figures, they will submit it to the accounting firm, they will tell them they need to perform an audit on the company. The accounting and audit firm will never perform that audit. They will just take the numbers that the business has provided, they will put their letterhead on it, create an audit, put the stamps, and send it back and charge them a nominal fee for it. I don't know if that happens in other parts of the world. Please let me know if that happens, but I've seen that happening here quite often. Now, the problem with that is quite evident, right? That it means that fundamentally a small business owner can put anything he wants in an audit. But when he presents an audit to a buyer, that document is going to be quite relevant, and that people are going to trust it and use it in some cases for evaluation purposes. What I came to realize is that audits cannot really be trusted so much unless you know not the firm but the person who did the audit, because that's another problem which we could dive into in this video. When you talk about audits, you also need to make sure that the person who's doing the audit is operating following certain principles. because it doesn't really matter if a big firm has put the name and the letterhead on an audit. If the guy doing it is not operating, in a straightforward manner, you're still going to face issues. And there are many cases that can attest to this. You can Google some of the recent lawsuits that happened to major accounting firms, fines north to 200 million. I'm not going to mention the names, but you can go look at it and tell me what you think. That kind of is going to show you how trusting the person who did the audit is key, because even a big name is not necessarily a guarantee of a pristine and accurate information. And so this digression to share with you the fact that creative accounting is a thing, and also documentation that you're going to use to perform due diligence might not necessarily be accurate. So it is important to, one, know who's the person doing these audits and talking to him, asking him questions during the due diligence, and then be careful about the business that you're analyzing, because they might have a lot of skeletons hiding, and they might have a lot of reasons for showing a picture that is a little bit different than it actually is. And again, we've seen many cases in the past of people creating this beautifully packaged document, sending it to buyers that were not necessarily aware of these things, have them look at the document, the buyer trusted the document implicitly, and submit an offer, close the deal, and then they realized the business was completely different and it was messed up. These were mistakes that even big companies made, because I think the mentality they operated with was that audits and other types of documents are pristine, by default. But that is not really the case. It depends on where you are in the world and how people operate in that arena. Here in the UAE, you gotta really be careful. Also in the Middle East, you gotta be careful. But I think provided you know these things beforehand, you then approach the analysis of the deal in a much better way. You're more skeptical about stuff, and you always look below the surface, right? You don't necessarily trust paperwork, and you do your own research, you do your own analysis before you decide, okay, this business is something we can pull the trigger on. And I think that's what this case told me about financial due diligence, creative accounting, and all these negative aspects about buying businesses. That being extra careful is key in the Middle East, and also I would say working with people who know where to look to find these skeletons is also important. And I guess I'll leave you with this last point, which is kind of a parallel to the one I just made about the audits. As I said to you, audit statements might be made by people who are just gonna put company letterhead on it, put a stamp on it, and send it back. So fundamentally, you can find anything in an audit. Now, how do you spot these deficiencies, right? Well, you either have people like us that are supporting you on deal flow, so we can spot these things quite easily, or your accounting team needs to be very, very good in spotting these things and needs to have experience on the ground. And this is the concept that I want to share with you. You want accounting teams that have years of experience working in this particular region. And the reason why I'm saying this is many times I've seen companies hire big accounting firms in the United Arab Emirates or the Middle East to undertake their due diligence work. And they worked with partners that were excellent people, but they had little to no experience in the region. So they might have been partners that were working in London, New York, or other places that were sent to the region, to the office in Dubai, Abu Dhabi, or Riyadh to, to pursue a new career path. The challenge with that was that these guys were very smart. They were book smart, so to speak, but they had only 2-3 years of experience doing deals in this region. They didn't know all the nuances and the problems that might arise during these due diligence exercises. That affected these companies a lot, because when these guys analyzed deals, they didn't know where to look for the skeletons. And in some cases, that due diligence exercise affected the decision of these companies. So my point here is, working with people that have a lot of experience in the region is key. Sometimes you might prefer to go with a little bit of a lower firm if you know there is a guy who has, 25 years of experience working here, because he's gonna be able to spot all these deficiencies. And even if the name is not so fancy, he's gonna be the one for the job. He's gonna be the one able to deliver on that. And again, I have nothing against big names, right? I'm just sharing with you what I've seen being the reality here. If people come in as partners or representative of these companies and they just spend 2-3 years in the country, it's just, evident that they're not going to have all the experience that is needed to successfully spot deficiencies in a deal. And that applies for big and small deals alike. So those are some considerations that I think are worth making when discussing this deal: creative accounting, questionable audit statements, and other due diligence exercises. So hopefully that adds some value to you, and I will see you in the next episode.